YPF Sociedad Anónima, Argentina's state-controlled oil company operating Vaca Muerta, the largest shale resource outside North America, with shale oil growing at rates rivaling the best U.S. unconventional basins.
Q1 2026, EPS $1.03 versus 83 cents, 24% beat. EBITDA $1.594 billion, shale oil 205,000 barrels per day, up 39%.
YPF was founded in 1922 as the first state oil company in the world, preceding Aramco and Pemex. Privatized in 1993, renationalized in 2012, and partially listed with the Argentine state as controlling shareholder.
The Vaca Muerta shale formation, discovered in 2010, transformed YPF's value. Spanning 30 million acres in Neuquén province, it holds recoverable resources comparable to the Permian Basin.
Horacio Marin became CEO in December 2023, appointed by President Milei's government with a mandate to accelerate Vaca Muerta production and advance the LNG export project toward FEED.
YPF's upstream shale drives profitability. $4 lifting cost is a record low globally. Shale oil at 205,000 barrels alongside gas, refining, and retail.
Revenue is in U.S. dollars, reflecting Argentina's hydrocarbon pricing policy. Q1 2026 revenue, $4.95 billion. Shale is the margin engine, downstream adds volume.
Q1 2026 EPS $1.03 versus 83 cents, a 24% beat. EBITDA $1.594 billion, beating estimate. Net profit $409 million versus near break-even prior year.
Lifting cost at $4 per barrel drives the margin story. At current oil prices, Vaca Muerta earns above sector margins, even accounting for Argentine country risk and FX exposure.
Vista Energy and Tech Petrol compete in Vaca Muerta shale production. Chevron and Shell operate as co-operators with YPF. None has YPF scale acreage or integrated value chain from production through retail.
YPF controls the most acreage in Vaca Muerta. $4 per barrel lifting cost means YPF is profitable across a wide range of commodity prices that would shut in higher-cost competitors.
YPF's integrated value chain, upstream production, downstream refining, and the only nationwide fuel retail network captures the full Vaca Muerta margin stack that pure-play independents cannot replicate.
YPF's core operations are in Neuquén province, the heart of Vaca Muerta, with refineries in La Plata and Luján de Cuyo. Fuel stations operate nationwide across Argentina.
The LNG export terminal is planned for the Rio Negro coast, connecting Vaca Muerta gas to international buyers at prices 3 to 5 times the domestic price. The FID targets mid-2026.
Horacio Marin has served as CEO of YPF since December 2023, appointed by President Milei's government with 30 years of unconventional oil field expertise from Tech Petrol and Total Energies.
Under Marin, YPF grew shale oil production 39% in 1 year and advanced the LNG export project toward FID, delivering Argentina's highest-profile industrial transformation to international investors.
YPF Sociedad Anónima, Argentina's state-controlled oil company, shale production 205,000 barrels per day, up 39%, $4 per barrel lifting cost. The Vaca Muerta case for emerging market energy investment.
Q1 2026 EPS $1.03, beating the 83-cent estimate by 24%. EBITDA $1.594 billion, net profit $409 million versus near break-even prior year. LNG final investment decision targeting mid-2026. YPF's export transformation is the next chapter.
Argentina's biggest oil company just posted the best Q1 in its history, and it did it with shale oil crossing 200,000 barrels a day for the first time ever. YPF reported $1.594 billion in adjusted EBITDA, up 28% year over year, with a 32% EBITDA margin. Vaca Muerta is no longer a promise, it's a production machine. I'm Hudson, she's Lana, and this is Charged Alpha.
YPF is Argentina's state-controlled oil and gas company with roughly $18 billion in market cap. The Argentine government owns about 51% of the company, with the rest publicly traded on the Buenos Aires Exchange and as American depositary receipts on the New York Stock Exchange. YPF operates across the entire hydrocarbons value chain: upstream production, refining, downstream distribution, and natural gas. It's also the dominant operator in Vaca Muerta, Argentina's world-class shale formation in the Neuquén Basin.
The company reports in US dollars for its SEC filings, which removes the Argentine peso volatility from the headline numbers. That's important context. Argentina has had severe currency instability for years, but YPF's dollar-denominated reporting gives investors a cleaner view of the underlying business performance. CEO Horacio Marin was appointed by President Milei's government in late 2023 and has been driving an aggressive shale-first capital strategy ever since.
Q1 2026 revenue landed at $4.946 billion, up 7.3% year over year and 9% sequentially from Q4 2025. The company had been expected to hit around $4.614 billion, so the beat was over 7% on the top line. That's a meaningful outperformance relative to consensus.
Adjusted EBITDA of $1.594 billion was the headline number, a record Q1 in the company's history, up 28% year over year and 24% sequentially. The EBITDA margin came in at 32%. For context, that margin level is competitive with mid-tier North American shale producers, not what you'd typically associate with a state-controlled Latin American oil company.
EPS came in at $1.03 versus the consensus of 77 cents, a beat of roughly 34%. Net income was $409 million. Free cash flow was $871 million, which is substantial relative to market cap and funds much of the capital program internally.
The shale oil production number is the real story. YPF-operated Vaca Muerta output hit 205,000 barrels per day, up 39% year over year and 5% quarter over quarter. That's the first time the company crossed 200,000 barrels per day on shale alone. Total crude, including conventional, was approximately 271,000 barrels of oil equivalent per day.
Conventional oil production was about 66,000 barrels per day, down 45% year over year. That's a deliberate exit. YPF has been redirecting capital away from mature conventional fields and concentrating it in the premier Vaca Muerta shale blocks. The economics justify it. Lifting costs in the best blocks are $3 to $4 per barrel, and the company's break-even is below $40.
Full-year 2026 CAPEX guidance was reaffirmed at $5.5 to $5.8 billion. The company-owned rig fleet is expanding from 12 to 18 rigs this year. Bringing drilling in-house reduces cost and tightens control over development pace. Net leverage improved to 1.57 times, demonstrating that cash generation is outpacing the spending ramp.
Horacio Marin joined as president and CEO in late 2023, handpicked by the Milei administration. His background is in oil services. He ran Tech Patrol, one of the largest private operators in Vaca Muerta. His mandate is to run YPF like a private oil company, cost discipline, shale-first capital allocation, and building toward LNG export infrastructure. So far, the results validate the approach.
The analyst community has been increasingly constructive on YPF as Vaca Muerta production data keeps confirming the formation's scale and economics. The bull case that's been building for a decade, that Argentina has a world-class shale resource that could rival the Permian Basin in unit economics, is now showing up in quarterly results.
Several sell-side analysts have raised price targets following the Q1 print. The key upgrade catalysts cited are shale volumes crossing the 200,000 barrel threshold ahead of schedule, EBITDA margins at 32%, proving the shale economics work at current oil prices, and the net leverage improvement, showing that the company can self-fund its capital program without diluting shareholders.
The political and macro context matters enormously for YPF. The Milei government's deregulation of domestic fuel pricing, moving Argentine pump prices to international parity rather than the heavily subsidized levels that existed before, is a direct revenue tailwind. Before the reform, YPF was selling oil domestically at below-market prices. That gap is now closed, which meaningfully expands the revenue base.
The IMF program and the relative stabilization of the Argentine peso to dollar rate under the Milei framework have also reduced the macro uncertainty that historically kept international institutional investors underweight YPF. The stock still trades at a discount to North American peers on EBITDA multiples, reflecting the Argentina risk premium, but that discount has been compressing as the macro stabilizes and the shale production story becomes undeniable.
The bull case is simple and powerful. Vaca Muerta is a Tier 1 shale basin with $3 to $4 lifting costs and a sub-$40 break-even. At current oil prices, every barrel of shale production generates extraordinary economics. The company is growing shale volumes at 39% year over year. It's expanding its own rig fleet to control costs, and it has an LNG export pipeline in development that could monetize Argentina's massive natural gas resource base into global markets.
The LNG angle is the optionality that long-term bulls are focused on. Argentina has massive Vaca Muerta gas reserves that are currently constrained by domestic market pricing and pipeline capacity. Multiple LNG export projects are in various stages of development. If even one of those projects reaches a final investment decision, YPF's gas resource base gets repriced from domestic constrained value to international LNG export value. And that's a completely different valuation framework for the company.
The bear case is Argentina itself. The country has defaulted on its sovereign debt 9 times. The Milei reforms are genuinely radical by Argentine political standards, and they face opposition from labor unions, opposition politicians, and the provincial governments that collect royalties from oil production. If political conditions shift, if Milei loses a key congressional vote, or if economic austerity generates social instability, the regulatory environment for YPF could change rapidly.
Oil price risk is real. YPF's economics look excellent at $65 to $80 per barrel, but the break-even of below $40 means the cushion exists. If oil prices decline toward $50, the EBITDA margin compresses sharply. And unlike a North American producer that can hedge on liquid futures markets, YPF's ability to hedge its production is constrained by Argentina's capital controls and currency framework.
Execution risk on the capital program is also worth flagging. $5.5 to $5.8 billion in annual capex is an enormous amount of investment for a company this size. Expanding the rig fleet from 12 to 18 in a single year requires equipment procurement, trained personnel, and operational execution. Argentine labor costs and logistics are different from North American oilfield services markets, and any execution stumble at this pace of growth could push costs above the planned range.
YPF's peer set spans Latin American and international oil producers. The most direct comparable is Vista Energy, which is also a Vaca Muerta-focused producer, but much smaller and privately operated. Vista tends to trade at a premium multiple because it lacks the state ownership complexity and political risk premium of YPF. Ecopetrol is Colombia's state oil company, a comparable governance structure but a different production profile.
Petrobras is the large-cap Latin American oil comp, Brazil's state-controlled giant with a much larger production base and a more established track record of capital markets access. Petrobras trades at higher multiples than YPF, reflecting Brazil's stronger institutional framework. If YPF can continue to demonstrate that Vaca Muerta delivers consistent results under Milei's stable macro framework, the gap between YPF and Petrobras multiples should compress.
Gran Tierra Energy is a smaller Latin American-focused E&P that some analysts use as a comp for smaller Vaca Muerta exposure. The key distinction is that YPF is the dominant operator in the best Vaca Muerta blocks. It doesn't just participate in the play, it defines the pace and economics of the play. That operator scale advantage in unit economics and infrastructure investment is something the smaller peers simply can't replicate.
YPF trades as American Depositary Receipts on the New York Stock Exchange under the ticker YPF. Options are listed and reasonably liquid by emerging market ADR standards. Implied volatility is elevated relative to U.S. domestic oil producers, reflecting Argentina's political risk premium. That elevated IV creates opportunities for option strategies that monetize the high premium, like covered calls or cash-secured puts, for investors who want to participate in the upside with some cushion.
The option skew on YPF is instructive. Put skew is persistently elevated, meaning the market is pricing in a fat left tail, a scenario where Argentine political or currency instability causes a sharp drawdown in the stock. That skew hasn't fully collapsed even after the record Q1, which tells you the market still hasn't fully priced out the Argentina risk premium even as the business fundamentals improve dramatically.
On insider activity, the Argentine government's 51% ownership creates an unusual dynamic. The government doesn't trade its stake in the open market. It's a structural holding. Provincial governments also hold interests tied to Vaca Muerta royalties. So the meaningful insider signal to watch is executive and board open market purchases at the ADR level on the New York Exchange. Purchases by the CEO or CFO in the ADR market signal conviction at the management level beyond what the quarterly results already show.
YPF delivered a record Q1. Shale production crossed 200,000 barrels per day, EBITDA margins hit 32%, and free cash flow reached $871 million. Vaca Muerta is delivering in the numbers, not just in geology reports.
The Argentina risk premium is real and it is not going away. But if you believe in Milei's macro stabilization and Vaca Muerta's economics, YPF at current multiples looks like one of the most compelling risk-reward setups in emerging market energy.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.